Alrighty, folks, we are obviously on the cusp of 2025. I think it warrants a discussion about what could potentially happen in the real estate and or housing market. You and I both know there are a lot of people calling for a housing or real estate bloodbath. Anna and I happened to not be in that camp, but I thought we would have some fun today and actually riff on what it would take to having a crash or a bloodbath in both multifamily and single family, because I think the story is very different. I think the time frame is very different and the setup is very different. But we are going to talk about both what it would take to have a significant crash or bloodbath in real estate values. Anna, I always believe in giving the lady the choice. Would you like to talk about multifamily first or single family?
Let's talk about multifamily and commercial, because I think it's a little bit easier. Number one, because we've already had basically a crash in commercial real estate values. They're down about 30% across commercial real estate. Multifamily's close to that range. Commercial's actually more than 30% when it comes to, for example, office and retail space. Industrial, not so bad. But essentially, when you talk about commercial real estate, let's just say values are down about 30%. And primarily that has been because of simply because interest rates rose. So when interest rates rise, the returns that investors who buy these assets that they demand for holding the asset, it's called a risk premium. It's something we should all know as investors, whether you're investing in the stock market, real estate, whatever it is. As you go up in risk, you're supposed to be paid a premium on the return that you get for investing in that thing. So when U.S. Treasury rates, went up significantly, let's say call it 4 to 5%, the risk premium, or in commercial real estate terms, the cap rate that investors demand goes up. So if they want to make a better return, what do they have to do? They have to get it for a better price. And so the value simply goes down because of the demand for that asset going down unless they can get a better price to generate the return that they need. So economics 101, and this will translate when we talk about residential as well, it's all about supply and demand. And then what is the price that the buyer demands for that asset? And is supply or demand higher? So when it comes to commercial real estate, interest rates going up is what's caused the crash, as well as, to your point, we had a lot of short-term debt. So very similar to what we saw in the great financial crisis with residential, is it wasn't that suddenly the economy was horrible, although there were signs of it weakening. It was that so many buyers had variable rate debt. And when that debt came due, they couldn't refinance, they couldn't get out of the loans. And so they just declared foreclosure, moved out, and there was this sudden huge amount of supply of a bunch of people that needed to sell because they couldn't afford that mortgage payment going up. And there just wasn't enough demand for those assets. So the prices started to fall. Same thing has happened now in commercial, where in the run up, post-COVID, 2001, 2002, we saw huge increases in prices. Everybody made the deal work for their returns by getting short-term debt, variable interest rates that were really, really low. And they just didn't think that interest rates could go any higher. They hadn't in about 15 years post GFC. And so suddenly all these short-term debt deals came up for renewal of their debt. They had to refinance. And guess what? They couldn't, because values dropped 30%. So now they're upside down. And so they've had to force sale, and there just simply weren't enough buyers. So for it to get even worse, and it could, I'm a commercial real estate investor, and I'm not naive to the fact that the mantra, Michael, was survive to 25. The Fed's on a rate cutting path. Inflation will come down. They're going to win the battle. They're going to cut rates. And that is going to make short-term debt rates that commercial are based on really low, and we'll be able to refi and be back to the norm. Well, the economy has been precarious, for lack of a better word, and we've still had higher inflation. We've had, numbers that seem to say there's higher GDP, and, we can debate about whether that's accurate or not, but we seem to be, everybody's excited that the economy has avoided this recession and we have a soft landing. And the problem is the Fed isn't cutting rates significantly. So if now we have a new administration, if we keep spending a bunch of money to bring back stuff onshore, deglobalization, all of that, and inflation starts to tick up like it has over the last couple of months, that could mean that the Fed may pause cuts. Maybe I think they'll cut today, but let's say they pause. Let's say inflation rears its ugly head. What's the Fed going to do? They might raise rates next year, Michael. And if they raise rates, a lot of these commercial real estate loans, they got their lenders to give them one more year. We're going to extend and pretend. We're going to give you one more year. We're not going to worry that your value's down. As long as you can make that payment, sometimes cash in, refi, we're going to give you one more year. Well, those banks are holding those assets, praying and hoping that the Fed cuts rates. As soon as the Fed doesn't, if they raise rates, not much less hold them, but if they raise them, suddenly the banks are going to start foreclosing on these assets. You're going to have even more supply, and you don't have buyers who can get loans because the credit has tightened so much that if these banks start to falter and fail, which we're already starting to see, most commercial real estate loans are held by small regional banks. If they start to struggle even more, they will hold back on lending. And that means a glut of supply, tons of supply, and buyers who can't get the financing and make the numbers work without a significant further decrease in prices. And the reality is this scenario is playing out, and it's likely that we can actually see further stress in the multifamily and commercial market. I hate to say it, we were all hoping that it would be better, but that's what could happen. And I think that there's a high likelihood that we can see more distress this year and even into 2026 before it's all over.
Yeah, when I think about the multifamily space, I think you're absolutely right. We've already seen a crash, right? I call anything over 20% a crash.
Yeah, me too.
And it's already there. I think there's a couple other subtleties that should be discussed here. And I think you're absolutely right. I think there's, for the first time, there should be a real discussion about inflation going up and thus, the Fed raising rates. And to your point, by financial institutions that will force, extend, and pretend to just stop, right? I think I think I've said this before, but I'll say it again here. I think there's a chance that we see a 50% value drop in Class B and Class C properties, right? There was a lot of artificial collapse in cap rate when, A's were trading at 3.5, B's and C's were, sub 5.5, which is not normal. So there's that reversion to the mean. There's also the fact that Class A is the only stuff retrading today. In my opinion, we haven't seen Class B and Class C unlock because the
Right.
delta between values. But, if 2025 brings, no rate cuts in the first half, we get a second whiff of inflation, and the Fed adds, a quarter or a half on the, raises rates. That could be because again, we've seen this movie before. Extended pretend works until it doesn't.
Right.
And it's like, it's really, really slow and then all at once. And to your point, the last thing that would really crash values in multifamily is the lack of lending. People don't get it.
Huge.
Banks, we were selling, it's huge. If they don't want to participate, you're left with cash buyers, and they're not going to take a 11% yield. They're going to want 30%. Right. So again, I think multifamily is on the cusp of a lot more pain in late 25 and maybe out to 26, but it could get really ugly.
Yeah, it could. And there, there's always counterpoints to this, right? We're talking about what would it take for it to crash. And there's things that could backstop that.
Correct.
But I think something that you said that's a really important nuance for those that are interested in commercial real estate, especially multifamily. We do have a lot of multifamily specifically that is backed by government financing, 30-year amortization, and up to 10 years fixed financing. And so there are lenders and properties that were really stable already, that have really good debt and will keep all of multifamily from falling, right? You're going to have a segment, though. It's the segment that are bought with bridge debt. And those usually, to your point, they're Class B to C properties that needed significant renovations in order to get rent bumps to bring them up to Class A kind of newish standards as close as they can. Those Class A properties are bought by REITs and institutional investors, and they pay cash. So they're not worried about going to get the loans, but they're not going to buy partially renovated apartment buildings, Class B stuff that didn't get all the CapEx to make them like new. Generally speaking, they're not buying those assets. So those assets are bought by other smaller investors, like a lot of syndicators, right? And what we have to do in order to buy those is we have to buy it at a steal. We got to get a great price, but you've got to be able to raise money from investors, and they want 20%. They wanted 20% annualized returns on their money when you renovate it and you sell it for a big upside, you hope, in the future. So many of those investors have been burned on this 30% value collapse where they've already lost their equity. So it's really difficult to raise money today, no matter how long you've been doing this business, for multifamily deals, because so many small investors, they're like, I've already lost on this one and this one and this one. You can't pay me to give you my money for 20%. And to your point, I think you use this number, they're going to want 25, 30% on their money, for the risk of taking on a property that doesn't have as much value in an unknown future with cap rates. And I hear this from investors all the time. It's why I've done very few large multifamily deals, because I can't find anything at a good enough price yet to pay my investors that higher risk premium and make it work. The other piece that's really important, just to touch on, is that the value of multifamily and all commercial it's a numerator and a denominator. So to make it real easy, it's the net operating income it'll generate before mortgage, before debt, divided by, it's the NOI divided by the cap rate, that return that investors want for their cash. And so we had a big hit on paper for the cap rate just because interest rates went up. But the other part that's really painful that nobody really saw coming to the extent that it has is that, renters cannot afford the rent bumps that they were willing to pay before, because they're now cash strapped. They've got massive consumer debt. They've got school loans that are resetting and coming due. We see a significant deterioration in renter quality on our applications. And so you can't force the rent bumps. And at the same time, property taxes and property insurance have skyrocketed to the point of, we've had properties in the South and along the coast. Our insurance went up 300 to 400% in a year or two. So nobody, no matter how good you are, nobody estimates, I'm going to project that my insurance is going to, quadruple or quintuple, but that's exactly what's happened. And so we've got pressure on the net operating income side because of inflation, specifically though, with taxes and insurance. And so you've got this pressure on both sides. And if insurance keeps going up, taxes keep going up, other expenses keep going up, wages that we pay our people to manage these properties, at the same time that these other things happen, that's even more glut of supply for investors who just simply can't make their numbers work. And so I think there's a lot more pain. Now, the government could backstop it, and I suspect that they might, right? Trump is a commercial real estate investor. It's how he made his money. And so you've got to incentivize, you've got to stop the bleeding. You've got to help the banks hold on to these properties and not foreclose. So I think the government could come in with some kind of rescue of the banks in order to rescue, the investors and everybody else and the tenants that live there. And I think that you're going to have significant tax benefits, like bring back 100% bonus depreciation so that you can incentivize people to buy properties and not let the whole thing collapse. But it's going to be very difficult for the government to backstop this, especially if we start to have banks start to fail. You'd have to see major bank bailouts to get them to lend when their current books are already so fragile, with the amount of both bonds and commercial real estate on the books. Many of them technically are insolvent if they're forced to recognize those losses that they haven't recognized yet.
Yeah. So I think in the short story about multifamily, aka commercial, there's a lot of kindling out there that could take a bad situation worse. I think it's arguable that we've already had the crash in multifamily. I do think Class B and Class C is yet to be recognized. But yeah, a lot of kindling, a lot of pain, a lot of risk, a lot of losses are certainly potential. But now let's switch to single family home, because I actually think single family home, because I've thought about this for a while because I knew we were going to talk about it. I think there's actually two paths to a meaningful crash, drop, bloodbath, whatever you want to call it, in single family home. And let's just be very clear. I'm going to talk about median home price for the country. I think there are two ways to have a drop in median home price. I know there's the, let's just go there. Do you have any idea how we might have two different ways, or which way do you want to talk about?
Oh yeah, I think there's several. We got to talk about supply and we got to talk about demand. So on the demand side, I think it's easy. It's the same thing that we just talked about with commercial. If interest rates continue to go up, despite the Fed cutting rates, which impact short-term loans, 5 years and lower generally, you see the long-term treasury market going up and you see mortgage rates on a 30-year fix going up, right? And nobody thought that would happen. And it's already caused a crash in transactions for the past couple of years. We're in a single family home, recession for lack of a better word. But if you want to crash prices, if you continue to squeeze demand and make people say, forget it, I'm not going to buy a house, I can't afford it, interest rates going up will cause more and more people to just back off and say, the house no longer makes sense, we'll just continue to rent. So I think that's the first one, is interest rates going up, inflation getting worse, and people not being able to afford that medium home with a general, even 3.5%, 5% down payment.
Yeah. I think one of the things that we're going to see very quickly in the story about single family housing collapse is the duration or the time frame from the first domino to pricing crash. I think is much longer than the commercial market, because I think commercial market, there's already dominoes falling and there's kindling just waiting to blow up. So let's just talk about this higher rate environment. So we're currently, round numbers, at 7%. We have seen 8%, in recent history. But you're absolutely right. If we take rates from 7 to 7.5 to 8 to 8.5 to 9 to 10, that will increasingly make this pricing crash or transaction crash go from 4 million to 3.8 to 3.5. And at some point, the supply of must sell versus want to sell will be higher than the cash buyers. And then you will have significant degradation in price. When you only have must sell and you don't have enough buyers and it's inverted, price crash every time.
Yeah. It definitely could happen. Again, I think the thing that might stop it from happening, and we've done a show on this a couple of weeks ago, is 70 to 80% of homeowners are actually 55 plus. They plan on not moving, and they've got mortgage rates below 4%. And a lot of them below 3%. So we've got this lock-in effect that unless you have something significant to increase those forced sellers, most of them are much better off staying in their home than trying to sell and rent or trying to sell and buy. So, it would have to be a really bad, really deep recession with national layoffs in every sector to make people forced to have to sell. I don't see that happening per se, but we definitely, again, you're talking national median, certain areas of the country, and I don't remember the stat because I just looked at it real briefly last week, but I want to say maybe 38 out of 50 major metros are already having big price decreases, like between 7 and 20%, in markets that were way oversupplied, overbuilt, and now the investors can't make it work, to your point about cash buyers being out. And neither can new homeowners. And so, I think certain areas of the country where you have oversupply or the prices just went crazy, there could be further falling. And then those people, especially if they're investors, are going to be forced to sell because they probably have short-term loans as well on those properties. So you're going to see an uptick in supply for sure. I just don't know that you're going to have enough mass supply. You'd have to have such a deep recession, almost a depression, for that many people to be forced to sell, in my estimation.
Yeah, I think there's a couple, again, one of the things I think people need to realize, at least in my opinion, with single family homes is any lead up to a significant price crash takes a lot of time. So let's just talk about the rate answer first, right? If you took interest rates up to 9% and you held them there for 2 years, that would eventually, I think, cause, the buildup of must sales to be higher than, wanna buys, because there's not a lot of people can buy the median home price today at 9% interest rate. It just doesn't make sense.
And that's a good point. It doesn't have to be mass supply. It just has to be more people that need to sell than you have buyers to buy for there to be enough equilibrium for prices to start coming down. So that's a really good point.
Yeah. So, and again, that would, and in my opinion, an environment where we have 9% interest rates and we have 9% interest rates for 2 years in a row, so 8 quarters. Today we're doing 4 million transactions. We would probably do something like 2.5 million. But again, once you get the supply of must sell, above the want to buy, prices fall. So that could be, that setup. That's one of many setups that could lead to significant price drops. But again, it's not 25. It's probably not even 26, but certainly could make 27 bloody if those things happen. Now let's go to the other one that I think most people talk about, and you brought up, nasty recession, right? We get to February, we're currently at 4.3, and then we jump to 5.3 and 7.3, and we're at 9% unemployment rate by the summer. Again, I'm just making this up because I want people to realize that in single family, the setup to get pricing crash is longer than you guys think. If we have 9% unemployment in June, let's just play. History says, and Housing Wire did an excellent article on this morning, or I read it this morning, I think it came out over the weekend, said that any lead up in supply, like meaningful supply growth, is at a minimum 6 months and likely 9 months later, right? Mm-hmm. Nasty recession, 9% unemployment. You don't get mass supply for 6 to 9 months. You got unemployment, you got, whatever severance packages, you got all these other things leading up. So even if we had 9% unemployment by June, I don't think we have a bloodbath in single family in 25. Could it happen in 26? Absolutely. You kept 9% unemployment from June of 25 until June of 27. You will have price degradation. What do you think?
Yeah, you definitely would. And the question is, what are the triggers that could make it that bad? And then how long do they last? One of the things that I think might be a little bit different now than it was, in previous recessions is we have our unemployment system, it does pay a little better. And we have governments that have proven we're not going to let you stay down in that deep of a recession too long. So what do? They give helicopter money. So it wouldn't be unheard of for them to go, guess what? We're going to give you an extra, 12 weeks of unemployment or an extra $400 a week or whatever it is to try to backstop that. But also we have to remember that recessions are fairly short-lived, generally speaking. I mean, we've had recessionary-like conditions for over a year, despite it not being declared. But generally the government's going to pump money in the system and try to get it from being too long and too bad. So will we ever go back to 9% unemployment rates again? I don't know. It would have to be really, really bad. Although we are globally in a recession again, right? These countries that were coming out, guess what? They're going back into recession. And so, when you have global recession before you're able to kind of reshore things and make everything happen here that's very stimulative, I could see that when it happens globally, just like it did during COVID and part of the GFC, unemployment could get much higher than what people think, at least for the short term. And then the question is just how long will it take? The other thing I think about, and I really don't know enough stats and data on this to make an educated guess, but I will say most people now are 2-income earners. A lot of people work remote. There is a gig economy, right? And so if people are in a home, let's just say they're locked in at 2.5%, 3% interest rates, I think they will do everything they can to preserve their home. And although they might let other things go bad, they might even go into bankruptcy, they're protecting their home as long as they continue to make those payments. And so, it could happen, but again, to your point, like, let's just play like, what would it take? It would take a really, really bad depression that lasts a long time, I think, for this to be a real possibility. For all those people that are hoping for major real estate crash, you'd have to hope for a really horrible economy in order to get that, I think.
Yeah.
For a long time.
Yeah. Well, here's the one. Here's a surprising one. I think it's going to surprise a lot of people. Maybe even surprise you. And it really goes back to the conversations I've had with my channel up front. So let me set this up for a minute. So first and foremost, you and I have already talked about a transaction crash, right? We went from roughly 6.5 million to 4 million. And I've said many, many times for years now, we are missing the move-up buyer.
Yes.
Right. So let's talk about what that means. So when you're missing a move-up buyer and you understand median home price, it's basically a series of home transactions. So if you line up a traditional list of 100 transactions or 101, so 50 is the median. But what has happened over the last 2 years? I've tried to tell people this many times. We have lost the front end of that. So if we usually do 100 or 101, and then we lose 30% of the low end, now instead of doing 101, we do 71. Guess what happens? Just because it's math. It's just math, folks. The median moves to the right. The median price goes up. So one of the reasons I think the median price has gone up so significantly, and it's bananas, is because we have lost the low end of the market, right? We've seen median home prices go from like 360 to 435 in a heartbeat.
Yeah.
I don't think anybody is talking about the fact that because we use median and because the housing market is broken and the Fed did that and we lost the low end, it's just math. The median moved because you've lost 30% of the transactions. I'll stop there for a minute. How does that setup feel?
Yeah, I think that's a really good point that I really didn't think too much about. I mean, we know that, first-time home buyers are pretty much out of the market. I mean, they're renters, they're being forced to rent. And so, you don't have a lot of even first-time home buyer homes come on the market. And those that you did have, Michael, through most of the country were in such bad shape and needed so much renovations. And when interest rates were low, that first-time home buyer was able to get in and they said, we'll just wait and we'll fix it up on our own, underestimating how much that would cost. But, you could sell a house that didn't have any work done to it, that needed a lot of work, for almost as much as you could sell one that was completely renovated a year before. And now you don't have the buyers that can do that when interest rates are 7%. The only reason they were able to do it before is because interest rates were 2 to 3, for a long time. So they've lost that. Plus, to your point, that has put pressure on that median to go up, which means if they're still looking, now they've got a higher rate and higher prices. They need a bigger down payment. They need a bigger income. They need a lower debt to income ratio, all at the same time where, 70% of Americans, again, are living check to check. 50% of Americans don't even have $500 saved. So how are they getting in with the down payment? Even on an FHA, it's put a lot of people out that simply don't have the 3.5%, to put down, or the 5% down on conventional. You add PMI to that. And those buyers, they're renters for years now. And so, yeah, that's a really good point, is what does that do to the median? It means only those that can afford, a lot more, which were a lot of investors. Now the investors can't make anything cash flow. They can't make a lot work on a flip. And so you're left with those high-end buyers, and most of them that can't afford it, they're paying more. If there's a lack of supply, they just want it. It's still a bidding war, or they just buy more expensive homes or new builds where they can get big incentives and mortgage point buy downs, and those new builds will still push those prices up as well. So I think that's a really good point.
Yeah. So we've got the setup, and again, just a number that everybody can go out and Google. According to National Association of Realtor, the first-time home buyer in a healthy market is roughly 40% of transactions, roughly 41, 42, whatever, call it 40. The last 18 months, it's been as low as 20 and as high as 24. So again, my thesis is accurate and backed up by data. So that's the setup. Now, How do you get a single-family house crash? You ignite the move-up buyer. You unlock the frozen inventory. You make it easy for the person who's been locked in to move up. And you know how you do that? You get 30-year mortgage rates to 3.5% or 4%. If you want a home price crash, you have to unlock the move-up buyer. You have to make entry-level housing go on fire. You take first-time home buyers from 20% of the market to 50% of the market, and you will see median home price crash. It will go from 430 or 460 down to 410. It's just math. That's how a median
Okay,
home price can crash. You unlock the entry-level housing.
maybe, but I think you could also have a crash up because I mean,
You could.
let's face it, you have tons of people that want to come buy again, and you have a supply that's locked in by a lot of people that are still like, hey, prices are higher. I've already got a low interest rate. I've already renovated my house. They've already done the move up. Again, I think we talked about like 80% or so are in these low interest rates. 70% of those are held by people 55 up that say they're never going to sell, and they've already renovated their homes. Of that 70%, almost the same 70% already renovated their homes. So they've already done the move up. I think you'd have to really entice them with a booming economy and low rates to move up again. But I think you have a flood of demand at low interest rates with not enough supply. So I think that would actually cause a crash up in values, just like we saw post-COVID, not a crash out. But again, it depends on, is supply unlocked at the same time? My opinion is the people locked into those low rates, we're not moving. We've already got a great deal on a great house when prices were low and interest rates were low, unless you're just dreaming of even a better house, and those that can. But how many of Americans can do that, Michael, when 70% are living check to check? Now they've got equity in their homes. They've got equity in the stock market, right? So you'll have some of that, but I just don't see it happening.
Yeah, it definitely, you're absolutely right. It could and probably would lead to a crash up. I'm just trying to think, because one of the things that is certain is we lost the low end. I mean, it's in the numbers, right? We're only doing 20% of the first-time home buyers. We used to do 40. And the longer that goes on, and we're into year 2, we're about to go to year 3 of the housing market being broken. There is a pent-up supply. There are people in a 3-bedroom that want a 4-bedroom, right? They just can't afford the 4-bedroom. They want to go from an older home to, right? So we do have a lot of the move-up buyer is there. To your point, and again, my call of 3.5 or 4%, it would have to be sudden, because to your point, if we just drifted from 7, to 6 to 5 to 4, I think you're absolutely right. Marginal demand will exceed marginal supply. I think if for some reason we snapped our fingers and, the FHA is going to buy all mortgages at 3.5. They're like the largest bond buyer or whatever happening. I have no idea how it happened. But if you took rates from 7 to 3.5, you could get that wave of supply to kind of, overwhelm the marginal demand. That's the only way you get this unlock. And the other thing is, I don't know if 3 years is long enough. I think if we stretch this out to like 8 years, and then you have a sudden drop in rates, that lock of supply could be large enough to dwarf demand. But yeah, to your point, it could also lead to a crash up.
Right. And I think it's really important for us. I mean, for those that haven't been, watching and trying to invest and different things, like this stretch of like, we're kind of in the same, I keep it very stagflationary type environment where you've got both, a not really strong economy in terms of GDP and wage growth anymore. I mean, you had it, but now it's kind of stagnated. And then you've also got inflation. And so the cost of living's high. As that goes on, houses are simply unaffordable. So, you would have to have a big economic boom, significant increase in wages in order for people to feel like they've got enough to afford, these new prices and low interest rates. But these things last a long time. And we thought we'd be in and out of this thing, and, recession declared at the, beginning of last year, or this year, I'm sorry. And we would have been on our way to recovery, but we haven't even had a technical recession yet. And we don't have anything to really spark a very quick recovery. I mean, even though there's a lot of positive things, and there's going to be a lot of things to boost, GDP, hopefully over the next several of years, it takes time. And so, we're just at the beginning of this kind of status quo, not much moving, and it could take years for us to really go through, enough of a recovery to where we have this big expansion again, where everybody's feels good. They've got extra money, they've got extra savings, and they're willing to go buy houses. And so I think, it could take a few years for those that are hoping we have this big crash. It takes time. It really could take time. And we don't know where the world is going, and that's one thing that the older and wiser and smarter we are, the more we know we don't know. I mean, we can look at the data, but these things have, what Lacey Hunt likes to call long and variable lags. And we can see macro picture, and we can see risks, and we can see positives. And the question is, how many of those risks materialize? How quickly? At the same time of how quickly do we spark the tailwinds that push the tide up for everybody, and we just don't know. But there's a lot of things that could cause global recession, global significant slowdown, if wars get worse, if Europe goes further into recession, if we go further into recession. Those things can significantly change the dynamics. And then what happens to the banks, and what happens to lending, and can the government afford to give incentives to get people to keep buying houses if banks don't? And all of that, though, is very inflationary. And so all of that means, whether government's spending or giving helicopter money, or we're in a recession and they got to get us out of it, it means higher treasury rates are demanded and higher interest rates in the future, most likely. And so those things could, again, materialize, but it's going to take, a few years to see that. And I think it's going to be kind of a slow fade, and it's going to be very geographically different. Those areas of the country that have strong, resilient economies, very diverse industries, better GDP than the nation, they're going to see values continue to go up, where other areas that are struggling more are going to see values continue to come down. So I love these macro and, big picture discussions, but you've really got to think about, like, where are you investing, and what's the likelihood of these things to happen in your local markets? That's what's really, really important. And then the other thing I'll just say, and we always like to say this at the end too, for everyone that's like, oh, Michael, this is such a doomy, episode. The reality is, if there's doom, there's huge opportunity. So, do I want, the kind of economic collapse that would be necessary for housing value, to crash? No. But if it does, do you think I'm going to go take advantage of the time to make great deals? Absolutely. Right. So we win either way. You've just always got to be looking for opportunity no matter what comes. And I think more people are hoping for these crashes. And I think these crashes are not very likely, even though we played with what would need to happen. So you just got to do good deals all the time, and have cash, be prepared to take advantage when there's blood on the streets, as they say. That's the maximum point of opportunity, but don't wait for it. My goodness, don't sit back and say, we're going to wait for 2 or 3 years because it's going to crash. Like, you may miss the boat in some of the best opportunities if rates keep going higher in the future and values keep going higher, which they tend to do over time.
Yeah. So if I kind of summarize this discussion, I think it's fair to say that both of us agree between residential and commercial. Commercial is far more likely to have a crash, just looking at the odds of the two. I think it's also fair to say that a commercial crash is potentially closer than a residential crash, right?
Yes.
We could see real pain in 25 and 26. Residential, I do not see a set of circumstances giving long and variable lags to really see any meaningful price crash in 2025. The system is just not set up that way. We could have a series of dominoes fall that lead to potential problems in 26 and 27. But to your point, the government will step in. They will do this, that, the other, forbearance. We know the whole story. But again, if you're hoping for that bloodbath in residential property in 2025, I think you are a little bit misguided. I don't think you understand how the system and lags work. Now, again, that's median home price for the country. Could your city, could your buy box drop 10%? Absolutely. Totally different discussion, right?
Yes.
But again, that's why I set this up as median home price. Anna, where can they find you?
Great. You can find me here almost every week on your channel, social media at Anna Kelly, REI Mom. And if you're looking for real estate coaching and consulting, you can find me at AnnaKellyInvesting.com.